Looking for income stocks with reliable high dividend yields and steady growth? One Canadian energy giant stands out: Enbridge. With a yield above 5% and an outstanding dividend history, it's a favorite for income investors. But it's not without risks. In this video, we'll break down what shareholders need to watch and what they can realistically expect going forward. Enbridge is a Canadian energy infrastructure giant, founded in 1949 and headquartered in Calgary. The company operates a massive pipeline and storage network that moves oil and gas across Canada and the United States, and invests in renewable power projects like wind and solar. Here's what dividend investors love. Enbridge has paid dividends without interruption since 1953 and increased them every year for the past 30 years. In 2024, the dividend rose by 3.1%. For the current fiscal year, management expects EBITDA at the high end of guidance and stable distributable cash flow per share. That makes another modest increase of around 3% very likely. Historically, dividend growth averaged about 9% per year. Since 2019, growth slowed down to about 4%. But going forward, Enbridge targets more moderate growth of around 3% annually through 2026. With a payout ratio of 60 to 70% of distributable cash flow, the dividend looks sustainable. What makes Enbridge special is its stable, regulated revenue base. Most of its contracts are long-term or government-regulated, with built-in inflation adjustments. Customers pay fixed fees for using the pipelines, independent of oil and gas prices. That means Enbridge's cash flow is predictable, supporting dividends even during volatile commodity cycles. Growth projects, like new pipelines, storage, or renewables, are financed separately, often through debt, new equity, or asset recycling, but are structured to be self-funding in the long run. Of course, there are risks. The core business depends on transporting fossil fuels, while the global energy transition aims to replace them with renewables. Over the very long term, demand for oil and gas, and thus the need for pipelines, may decline. Other risks include regulatory changes and especially higher interest rates, which tend to pressure income-focused stocks like Enbridge. In fact, when North American interest rates rose sharply after 2015, Enbridge's stock lost more than 40%. More recently, hopes for lower rates under President Trump boosted the stock back to record highs. So, what can investors expect? Enbridge currently offers a dividend yield of about 5.4%, attractive for income seekers. Combined with modest growth potential, it's a solid pick for diversified portfolios focused on passive income. Still, investors should keep in mind the long-term risks of the energy transition and interest rate sensitivity. Short-term dips are likely, but as long as oil and gas remain essential to North America's energy mix, Enbridge should continue to deliver dependable dividends. Thanks for watching. If you found this video helpful, don't forget to subscribe to the channel.